Hello everybody and welcome back to iQinvesting. In today's video, we thought we'd go through some of our top tips for index fund investors. We've collected these top 5 tips whilst running the channel over the past few months. Not only do they stem from painful personal experiences, but it also comes from the common questions that we often get on our recent videos. We're going to try and avoid some of the obvious points that you may have read about already or maybe seen other videos on. We're also going to back these points up with some research so that you learn something new along the way. So without further ado, here's our top 5 tips for index fund investors. Tip number 1. Don't check your investing account every day. Now admittedly, this first one is a tough one. And being truthful, it's something that my brother still struggles with now, and it's something that I definitely had to work on over the past few months when it comes to investing. So do as he says, but not as he does. But yeah, we get it. The temptation is there to check your investments every day to check the progress that you're making towards your certain goal. But what we have to remember is that we are investing for the long term. And so, a day-to-day fluctuation in the market is going to happen. The key is to ignore these day-to-day fluctuations and keep focus on a long-term investment horizon. A perfect example is a study conducted by Fidelity. The study tried to figure out which type of investors earned the best returns from 2003 to 2013. The customer account audit found that the investors with the best returns were either inactive or dead. So we think that the lesson to learn from this is to not meddle with your investments. And the best way to do that is to not check your investments every day and let your emotions get a hold of your decisions. Tip number 2. Don't overlap funds. We get plenty of these sorts of comments in our YouTube comment section. Should I hold an S&P 500 fund with a global fund? Or maybe a FTSE 100 fund with a life strategy fund? To be honest, you can hold whatever funds you like. Don't let us stop you. And whilst we're on that topic, remember that we're not financial advisors, so if you do want financial advice, then seek out a professional who can give you advice tailored to your own circumstances. But what we can tell you is that if you're trying to track the global markets in the standard market capitalization weighted way, then buying multiple funds is just going to make it complicated. One way to get around this is to invest in simple global funds. These are funds that track one of the global indices, such as the MSCI World Index or the FTSE Global All Cap Index. Check out our videos on VWRL or the FTSE Global All Cap Index Fund for more information on those. But why should we care about market cap weightings? The rationale behind a market cap weighted index being the optimal way to track a certain market stems from the idea that many investment professionals and academics agree that the markets are efficient. In an efficient market, all public information is reflected in the price of each stock. Each stock price is the best approximation of a company's fair value at any given time. So, buying the whole market and spending time in the market is often much better than trying to time the market, or even select winners in that market. What do we suggest? Buy a global fund and stick with it. Tip number 3, choose a fund and stick with it. This is a common pitfall for many investors, and it's a trap that we've certainly fallen into in the past. When you purchase a fund, on most platforms, you're likely going to pay a transaction cost, a one-off cost, or both. Take Vanguard for example. When you buy an ETF with Vanguard, you are charged a one-off cost. This cost is associated with the bid-to-ask spread. You're also likely to pay a transaction cost, which are the fees associated with trading. Now these fees are usually quite small. On Vanguard for example, let's take a look at VWRL, where the transaction cost and one-off costs are 0.03 and 0.04% respectively. That doesn't seem too bad. But if you're a type of investor that likes to switch between funds on a regular basis, then you need to watch out. You'll be incurring these fees each time you buy a new fund. The more we buy and sell funds, the more fees we pay, which takes away from our overall returns. And these fees can be even higher on other investment platforms. Take AJ Bell for example, where trading an ETF costs £9.95 per transaction. Or Hargreaves Lansdown, where trading an ETF can cost anywhere between £11.95 and £5.95 depending on how many times you trade an ETF within that month. So make sure to keep an eye out for these fees on your investment platform. When you see an ETF or fund that you like and you've formulated a long-term investment plan, buy a fund and stick with it. Tip number 4. Don't look at past performance. Now admittedly, this is an interesting one. In some of our previous videos where we review Vanguard funds, we often get the question in the comments saying, why didn't you look at the past performance? Now, on face value, we understand why people want to see past performance, especially when considering active funds. If you want to choose a stock to invest in or an active manager to give your money to, then you'd like to know how they did in the past. But why? Have you ever actually considered why we should care about past performance? We've all seen the messages on almost every investment website. Past performance is not a reliable indicator of future results. Should we take any notice of this? Well, we'd argue Yes. Especially if you're investing in a broad range of passive funds, you should not look at the past performance to help you decide which fund to pick. A study conducted in 2008 by Amit Gayal and Sunit Wahal, titled "The Selection and Termination of Investment Management Firms by Plan Sponsors," explains this point quite well. They studied the following. We examine the selection and termination of investment management firms by 3,400 plan sponsors between 1994 and 2003. Plan sponsors hire investment managers after large positive excess returns, but this return-chasing behaviour does not deliver positive excess returns thereafter. So basically, they're looking at newly hired fund managers who performed well recently to see if they kept up their outperformance. This is what they found. We find that plan sponsors hire investment managers after superior performance, but on average, post-hiring excess returns are zero. Plan sponsors fire investment managers for many reasons, including but not exclusively for underperformance. But post-firing excess returns are frequently positive and sometimes statistically significant. Interesting. So essentially, after hiring fund managers that performed well in the recent past, they just revert back to the mean. This sometimes ends up with them getting fired. Oops. And after the period of underperformance, when they've been fired, they then go back to outperforming. We'd argue this is the danger of selecting active managers based on their past results. It highlights the issue of outcome bias in the random world that is investing. The returns of stocks are inherently random and hard to predict, but sometimes when we look at past results, we just put a reason to those results and make it seem like it was obvious all along. Ultimately, looking at past returns will not reliably indicate future results. So we should stop chasing past returns from certain countries, managers, or markets. Instead, we like to diversify across these different market sectors and countries and accept the returns that the global stock markets produce. Tip number 5, keep fees low. Okay, we kinda lied at the beginning of the video. We said that we try to avoid the most obvious index fund investing tips, but this one, we just have to say it. Keeping investing fees low is still one of the most important factors when it comes to index fund investing. Any annual charges that we pay to invest in our funds eat away at our returns. Always check the ongoing charges for funds before you invest in them, and keep an eye out for other similar funds that may have a much lower ongoing charge. Websites like justetf.com and etfdb.com are great tools for investors to check out lists of funds available in the UK. You can search through lists of ETFs and sort the ongoing charges to make sure you're getting the best price for funds. So there we have it, our top 5 tips for index fund investors. If you have any key tips that you think that we missed out on, make sure to drop them in the comments below so that other people can see them and learn from them. As always, if you enjoyed the content, make sure to hit the like button and press subscribe. I mean, you already know what to do, and you know what, we'll see you next time.